Hey everyone, and welcome to This Explainer. Today, we're doing something just a little bit different. We aren't just going to look at numbers on a balance sheet. Instead, we're performing a diagnosis, specifically a diagnosis of the hidden mental traps that silently sabotage our wealth. Honestly, if you've ever felt like you're doing absolutely everything right, but you still just aren't getting ahead, you are in exactly the right place.
You know, there's this really fascinating truth about how we handle our finances. Intelligence doesn't protect you from bias, it hides it. You can read literally every book and master every investing rule out there, but no matter how smart you are, your intelligence doesn't shield you from your own biases. It just gives you way better excuses for them. And that's because managing money isn't just a math problem. It is a deeply psychological, behavioral challenge. Okay, let's dive into this. Section 1, Money is not math, the logic illusion. This is where we start to see why we so often mistake our personal biases for objective reality. Imagine a graduate who just entered the workforce during the devastating 2008 market crash. Now, compare them to a tech worker who made an absolute fortune during the booming 1990s. If you give them both the exact same investment data today, they are going to make entirely opposite choices. One is going to run away from risk, and the other is going to chase it. They're looking at the exact same numbers, but they're looking through completely different lenses. And the crazy part? Neither of them is crazy. They're just trapped in their own financial bubbles. As the author Morgan Housel points out, spreadsheets are coldly rational. They don't panic during market downturns, they don't feel stress, and they definitely don't compare themselves to the neighbor's flashy new car. But you and I? We do, because we're human. So building a mostly reasonable financial plan that you can actually stick with when things get tough is infinitely better than building a mathematically perfect plan that you just abandon the second you get scared. Which is why we really have to ask ourselves, why does pessimism always sound like incredibly helpful advice, while optimism just sounds like a naive sales pitch? Well, it's because pessimism is loud, right? It's emotionally gripping. A sudden 40% market crash is going to dominate the headlines for sure. But true optimism, like a quiet, slow 140% gain over several years, barely even gets noticed. Real optimism isn't about ignoring risk. It's about expecting setbacks, but fundamentally believing in long-term, quiet growth.
Moving right along to Section 2, the illusion of control, luck, risk, and narrative.
Now, what's really interesting about this slide is the contrast. We all know Bill Gates, right? Brilliant, calculated, wildly successful. But back in the 1970s, he had the 1 in a million luck to attend a high school that actually had a computer. Now look at his friend, Kent Evans. He was just as brilliant, just as obsessed with computers, but he tragically died in a mountaineering accident before even finishing high school. That is a 1 in a million risk. These two wildly different outcomes prove that success and failure are heavily driven by unseen forces of luck and risk, far beyond our actual control. This chaotic reality of the world is governed by what we call tail events. These are rare, extreme events that drive almost all outcomes. But the thing is, humans don't like randomness. We crave a good story. Just think back to the 2021 crypto boom. Thousands of coins with absolutely no real purpose exploded in value simply because people bought into an appealing fiction. It was driven by a great story rather than underlying math. But as we all saw, when reality hit, the story totally collapsed. So just how powerful are these tail events? Consider the number 10. Warren Buffett is widely known as the greatest investor of our time, right? He has owned hundreds of different stocks throughout his entire life, but nearly all of his massive, unbelievable wealth came from just 10 rare tail events. Things like his quiet, completely unflashy purchase of Coca-Cola way back in 1989. And it's not just Warren Buffett. Since 1980, just 7% of the companies in the massive Russell 3000 index drove all of the market's net gains. Just 7%. To put that into perspective, this is an incredibly liberating fact. It proves that you can literally be wrong half the time in your decisions and still win absolutely massive if you just let those few positive tail events run their course. Which brings us to the climax of our diagnosis here. Section 3. Ego versus true wealth, the silent destroyer. Let's consider the ultimate cautionary tale of the never enough trap. By age 29, Sam Bankman-Fried had built an empire worth $20 billion. He had universal media praise, endorsements from celebrities. I mean, he had basically won the game. But the word enough just wasn't in his vocabulary or his plan. He risked his customers' funds not to survive, but simply to chase more. More status, more admiration, and he lost the whole shebang. We chase status because we desperately want to be admired. But that leads straight into the man-in-the-car paradox. When you drive a flashy Ferrari down the street, onlookers aren't actually admiring you. They are completely ignoring you, and instead, they're picturing themselves behind the wheel. Buying expensive stuff just to be admired is a remarkably weak tool, because people just use your visible wealth as a giant mirror to reflect their own desires. And this introduces the ultimate financial paradox. Looking rich and being wealthy are almost entirely opposite things. Looking rich actually requires spending money so other people can see it. But true wealth, it's completely silent. It consists of the financial assets you don't see. It's the money you didn't spend to upgrade the car or that luxury vacation you didn't flash all over Instagram. So the crucial point is this. Saving money isn't just a function of how much income you generate. It's the gap between your ego and your income. Building wealth is actually about needing less. It's about reducing your ego's endless demand to impress other people. When you can drop your ego, your savings rate is going to skyrocket.
All right, let's look at the cures. Section 4, time, survival, compounding, the long game.
The very first cure is a massive mindset shift about volatility. Look, investing isn't free, but you don't pay the toll in cash, you pay it in stress, doubt, and those stomach-churning market drops. If you view a market drop as a fine for doing something wrong, you're going to quit. But if you start treating it as a fee, the standard expected emotional price of admission for long-term gains, you will actually stay in the game.
To prove this, consider this absolutely staggering number, 94%. Between 2002 and 2018, Netflix stock returned an unbelievable 35,000%. But to get those gains, you had to endure pure agony, because the stock spent 94% of that entire time trading below its previous all-time high. Constant discomfort is quite literally the fee you must pay to win.
And this brilliantly illustrates the ultimate reward for paying that emotional fee: time. Look at Warren Buffett's timeline. He started at age 10, hit $1 million at age 30. But out of his roughly $160 billion net worth, he made $156 billion of it after his 65th birthday. That is wild. It's not just about his talent. It's about the sheer gravitational power of time and uninterrupted compounding. But here's the catch. To let compounding work, you have to survive. Benjamin Graham noted that a margin of safety makes forecasting unnecessary. Getting rich might require taking a risk, sure, but staying rich requires what we call a barbell personality. Bold optimism for the future on one side and intense, paranoid caution for today on the other. You need that margin of safety to endure the unexpected crashes without panicking. Finally, Section 5. Play your own game. Context is everything. You have to plan for a moving target. Psychologists call it the end of history illusion. We know we've changed massively over the last 10 years, yet we foolishly assume we're going to stay exactly the same for the next 10. This is exactly why extreme financial plans always fail. If you lock yourself into an extreme path, you leave absolutely no room for your future self to change their mind. Building a plan based on moderation leaves you the breathing room to adjust later without any regret.
And because you are changing, your strategy must be exclusively yours. Never blindly copy someone else's moves. Look at the stark difference between a short-term day trader and a long-term investor. If you copy a day trader's hot stock tip, you are inheriting their specific risks without sharing their timeline or their goals. Context is absolutely everything here.
So all of this brings us to the single most important question you can ask yourself. What game am I actually playing? Is it a game to impress strangers at a stoplight? Or is it a game to buy back your own time and freedom? To truly master the psychology of money, you have to define what enough means for you. Stop playing other people's games and prioritize your own peace of mind above absolutely everything else. So take a really hard look in the mirror today and ask yourself, whose game are you